On July 10, 2026, the Indian equity markets closed at a record pace. The Sensex climbed over 800 points, while the Nifty 50 finished the session above the 24,200 mark. To an outside observer, these moves often look like noise, a series of green and red bars reacting to the whims of a chaotic system. When trillions of rupees in valuation materialize in a few hours of trading, the scale of the move suggests a system far beyond individual control. But these rallies are rarely the result of random chance. They are the product of specific economic incentives aligning at a single point in time. Stock prices are a real-time sensitivity test, reflecting how millions of participants interpret incoming data. The July 10th rally was driven by a specific convergence: corporate earnings, domestic stability metrics, and a reduction in external risks. When we examine the data, we can see how these distinct factors provided the structural support for the day's record highs. By breaking down the performance across these three areas, we can see exactly why the market moved. Markets derive their baseline value from the health of the underlying businesses. The primary catalyst for this rally was Tata Consultancy Services, which set the tone for the entire IT sector. TCS reported sequential revenue growth of 0.4%. While the number seems small, it was at the top end of analyst expectations and was supported by their highest hiring figures in 4 years. This served as a signal for the broader technology sector. Shares of Infosys, Tech Mahindra, and Wipro saw immediate buying interest as investors adjusted their outlook for the industry. This momentum shifted into the financial sector. This bank Nifty chart shows a breakout from a tight consolidation zone, with the PSU Bank Index gaining over 4% as expectations for strong quarterly results spread to the lenders. Tangible corporate earnings provide the evidence investors need to justify deployment of capital. However, corporate performance is often capped by the domestic economic environment. A major domestic factor on July 10th was the drop in Brent crude oil to $76.55. For an oil-importing economy like India, cheaper energy costs help lower the import bill and ease local inflation concerns. This shift supported a 15-pence appreciation in the rupee against the dollar. This easing of pressure was reflected in the India VIX, a gauge that tracks the market's expectation of near-term volatility. This Nifty chart shows the index holding firm support at the 23,800 level. During the session, the VIX dropped by over 8%, signaling that participants felt more comfortable with the current risk environment. When inflation concerns and volatility metrics drop simultaneously, investors have the necessary green light to increase their exposure. The third factor is the global capital environment. Indian markets do not trade in isolation. Global cues were supportive across the board. In the US, the Nasdaq and S&P 500 were trading near elevated levels, while the Nikkei in Japan showed sustained strength. Investors were also monitoring a de-escalation in tensions between the US and Iran. A reduction in geopolitical tail risk, those high-impact, low-probability events, allows global capital to flow more freely into emerging markets. With the international backdrop stabilized, one of the final barriers to domestic buying was removed. When these variables converge, we see broad-based participation across the market rather than isolated gains. On July 10th, the buying wasn't restricted to the top 50 companies. The momentum spilled into smaller companies across various sectors. This technical outlook shows an advanced decline ratio of 1.5, meaning for every 3 stocks that rose, only 2 declined. The mid-cap and small-cap 100 indices both climbed nearly 1.5%, closing at record highs. This widespread participation confirms that the rally was a market-wide reaction to an improving outlook. The stock market is not a casino. It is a clearinghouse for global and domestic data. When we see indices hit new highs, we are seeing the logical result of corporate efficiency, easing commodity prices, and international stability. The next time the market surges, look past the headlines. You'll likely find a series of specific economic forces aligning to drive the move.